Hi, Lori here to talk about securities markets for work and play. The very first thing we're going to do is talk about what do securities markets mean for companies. And usually they're used to finance your long-term debts. When you are on the company side, you can use your retained earnings, or you can borrow money from lending institutions like banks. Also, pension funds and insurance companies are great sources of money for big projects. So if you're on the company side and you're a financial officer for the company, you'll want to look into those. Um, or, as we talked, you can go to the securities markets, and that's issuing stocks and bonds. They also issue other things like collateralized debt obligations, but you don't really need to know that. It's just kind of an interesting thing. There are two types of markets: the primary market, and that's where companies sell their own stock, and the secondary market, where third parties buy and sell a company stock. So, for example, if Google were to do an additional issue of stock, they would sell the stock, and if Mattia and I bought it, our money would go directly to Google, and Google gets to keep the money. However, in the secondary market, if I have my stock, Google stock, and I want to sell it, and Mattia wants to buy it, I get Mattia's money, Mattia gets my stock, and Google gets nothing from that transaction. When you are doing a stock or bond issue, you probably want to use an investment banker, and that's because they will help you with all the paperwork, and it's quite extensive and very important that you get it right. And on occasion, they will buy up the whole offering and resell it. They make money at that because they buy it at a discount and then sell it at a regular price, but it does reduce the risk for the company, and that is called underwriting. Institutional investors are people or firms, organizations that invest their own money or money they hold on other people's behalf. So pension funds and mutual funds, they're holding other people's money. In insurance companies, they're investing money that they need to invest while they wait to pay claims. In either case, institutional investors have a lot of money to invest, and that means a lot of power in the marketplace. Stock exchanges, that's where brokers can buy or sell shares. New York Stock Exchange is one, OTC is another, NASDAQ, and there are other exchanges as well. So for the content quiz, please go on Investopedia or Yahoo Finance or Morningstar, any of those, or Google Investors. Any of those are fine, and find another exchange from somewhere in the world. And the strangest exchange that comes in the door on the content quiz will get a prize. So, who's watching all this activity in the securities markets? Well, it's called the Securities and Exchange Commission. It's a government body, and they require full disclosure on the financial side, and they guard against insider trading. Financing with common stock, there are some advantages and disadvantages. Obviously, an advantage is you don't have to repay the investor. If I buy Google stock and I want to sell it, I can sell it directly to Mattia, and Google doesn't have to come up with money for me. That's a good deal for Google. You also don't have to pay dividends by law. You may choose to, but you don't have to. And of course, stock makes your balance sheet look good because your equity goes up. Some disadvantages are that it may alter the control of the firm because now you have more owners. The dividends are not tax deductible, and that can get expensive because taxes for large companies can run in the range of 34% on the margin. So if your dividends are not tax deductible and your interest payments are, that makes interest payments actually a lot cheaper because they're subsidized by the government. And then finally, stockholders can second guess management and oust them, and that's not a positive thing. Think of poor Steve Jobs, who had a job at Apple, then didn't have a job at Apple, and then came back and had a job at Apple. But that was all because stockholders chose to change management. Note on preferred stock, you don't get to vote. You do get dividends paid to you before common stockholders get their dividends, and it might be callable, which means you have to sell it back to the company. Financing with bonds, again, advantages and disadvantages. Let's go over the disadvantages first. Well, you have to make that interest payment. If you don't, you're in default, and your creditors, the people who hold your bonds, can take you to court to get you to pay. It also increases the debt on your balance sheet, and that can make your company look more risky because your debt to equity ratio will go up. And finally, you do have to pay back the amount the investor gave you for the bond at the beginning. You have to give it back at maturity. Some advantages are that the bondholders don't get to vote, that interest is tax deductible, as we discussed. The debt is eventually repaid, and your balance sheet does improve. And if your bond is callable, you can convert the bond to common stock. How do you play? So that's the work side. Now let's talk about you as an individual. How do you play in the market? Well, you can buy individual stocks or bonds using the traditional broker channel, or you can use e-brokers like E-Trade and Ameritrade, etc. You can buy mutual funds, which can be made up of stocks or bonds, and you buy shares in mutual funds, or you can buy exchange traded funds, and those are collections of stocks and mutual funds. 5 criteria you want to pay attention to for investing is: how much risk do you want? How much yield or reward are you going to get? What's the duration of your investment? Will you be able to get it back? And when will you be able to get it back? Liquidity, which is how quickly can you turn it back into cash in the event that you needed it? And what are the tax consequences? Will you be getting taxed at the regular income rate, or will you be getting capital gains? And that's a more sophisticated topic, but if you want to take investments, you can learn all about that. So, how is the market doing? Well, bulls are people who think that the market is going to go up, and bears are people who think the market is going to go down. And the market is always full of both varieties, and that's what makes it exciting and fun. In the U.S., we typically watch 2 measures: the Dow Jones, which is just 30 stocks, and the S&P 500. So if you listen to Bloomberg, MSNBC, any of those channels will be reporting what happened with the Dow Jones today and what happened with the S&P 500. In general, over time, stocks are higher risk, higher reward. The average for the last 100 years on stocks is between 11 and 12% return, which is phenomenal. The investment grade bonds, and those are bonds for companies that are very, very strong, like General Electric, Procter & Gamble, Johnson & Johnson, that sort of thing. They are lower risk, but they are also lower reward. Over the same period of time, they tend to return about 4 to 5%. There are 3 big ideas from this chapter. One is to match your strategy to your needs on the investment side. You want to watch whether you want growth or income from your investments on the personal side. And from both the company side and the personal side, never forget the risk-reward trade-off. That's it for tonight. I hope you're having a good one. Bye.